Hey friends, I'm back. I have a stock, a dividend paying stock. Actually, I should say it pays a distribution. It's a REIT, a real estate investment trust. It's called Realty Income, ticker symbol O. I just increased the size of my position by 50%. Yes, I made a big move with this particular REIT. My patrons already know that. I'll link in the pinned comment below to my Patreon. And I want to discuss this move in the video today. I want to talk about the pros and the cons, or the risks, with this particular REIT and why I went ahead and made such a big move. I want to start out with an example. And as you can see on the screen in front of you right now, the foundation of this example is the Treasury rate. Right now on a US Treasury bond, the long bond, not the longest bond, but the 20-year bond, the interest rate is 5.146%. For all intents and purposes, most investors look at that as a somewhat risk-free interest rate. And so when I buy a company, a real estate investment trust like Realty Income, I have to look at things through that lens, because Realty Income is a bond-like proxy. They go out to the debt markets, as I will share in the video today, to raise capital. And that long-term interest rate is really important to understand because it affects the value of the leases. One of the most important points that I want to share in the video today is the value of Realty Income. It's actually not only the real estate. I would actually say the real estate is secondary to the most important valuation metric of Realty Income. And that most important valuation metric are the leases themselves. So as you can see on the screen in front of you right now, this is just one example, but this is the lease that they just struck recently with MGM for the Bellagio. You can see there on the screen that the cap rate is 5.2%. So it's just slightly higher than that 20-year long bond. Now, worth noting, what I love is there are rent escalators. Next 6 years is at 2% per year. And then after that, it's the greater of 2% or CPI, but it gets capped at 3% in years 11 through 20 and 4% in years 21 through 30. This lease is just one of their leases, but it's very important to explain that Realty Income, much like the 20-year bond, is a long bond, a long investment of sorts. They get in to these long-term leases. And as I said, the value of this company, it's not only the real estate, but it is the leases. Let me explain. Right now, I would say this lease with Bellagio, more or less, it's kind of valued at par value. It's right around where you would expect it to be based on current interest rates. But let's say all of a sudden that rates skyrocket even more than they have already. Well, this lease, this asset, will be much lower in terms of valuation than it is right now. Why is that? It has to normalize to where the market is. It would trade as any other security based on current interest rates. Now, the Bellagio is a very good quality asset. I think it's a company, MGM, will be able to pay their bills, but nonetheless, this lease at plus or minus 5%, if current interest rates go up to, say, 10%, especially longer term interest rates, because this would be compared to longer term rates like that 20-year bond, if that goes up to, say, 10% or more, the value of this asset for Realty Income would plummet. It would get cut in half. And the stock overall at Realty Income, the REIT, would drop in value. So that's a really important concept to understand, because when I increase my position here in Realty Income by 50%, I am making the calculated bet that interest rates right now have probably peaked. They're going to start tapering off, may even decline in the future years. But what I want to do now is I want to go through my purchase and some of the pros and cons. Before I do that, if you own Realty Income, please put in the comments below. I'd love to know if you own this real estate investment trust. As you can see on the screen in front of you right now, let's dive into some of the metrics. So as you see on the screen, I purchased my units in Realty Income for $49.87. The 52-week high was $68.86. And so it is off the 52-week high by 27.6%. It has trended down quite a bit since its 52-week high, hence it caught my attention. I don't buy REITs or stocks just because they're off their 52-week highs, but that certainly is a leading indicator that, hey, Ian, you may want to take a look at this to find value. And value is exactly what I found here at Realty Income. On an AFFO basis, adjusted funds from operations, that's the earnings equivalent of a real estate investment trust. Those are the funds from operations that could be distributed to unit holders. They're expected in 2023 to come in at $3.96 on the low end of the range. They also have a higher end of the range, which wasn't too far off from this. Now, if I back into a price earnings ratio based on AFFO, it's actually pretty easy. I just take the share price I paid, which is more or less where it's trading at right now, the $49.87. I divide by 396. I get an AFFO-based PE of 12.59. That right there is one of the main reasons that I added to my position. At a PE equivalent, looking at it through AFFO in the 12s, I see a lot of value here right now with Realty Income. Check it out on the screen in front of you right now. I want to continue. One of the things I love about Realty Income right now for my current situation is they pay the distributions monthly. They're the monthly dividend company. I love that because I use these distributions to help pay bills, and coming in monthly makes all the difference. Now, the distribution yield right now is a staggering 6.16%, and on an AFFO basis, payout ratio is 77.6%. And so it is yielding more than the US Treasury. In fact, this is one of the pros that I want to mention today. This is a bond-like investment. This isn't qualified dividends. The tax complications of this type of investment are more than a qualified dividend that would come from one of my bread and butter core 4 style investments. But what I love about Realty Income is it's a bond-like proxy, but it's yielding more than the risk-free rate of the 20-year Treasury, and it has built-in dividend increases in there as well, because as you can see on the screen in front of you right now, as I go down the chart on the screen, you can see that over the last 5 years, they've increased the distribution on average by 3.03% per year. And so, yeah, it's not a huge compound annual growth rate, but it's something. And also worth mentioning, bonds reset. At the end of 20 years with the Treasury, I get my capital, my principal back, and I have to redeploy it. And I don't know where interest rates are going to be in 20 years. Maybe they'll be a lot lower than now, and I'd have to redeploy at a lower interest rate. What I love about Realty Income is it's a bond-like proxy. It doesn't reset. It's a forever yield, and it hopefully will forever continue to grow as well, albeit at a slow pace, only 3.03% per year. Certainly, this is an investment that probably appeals more towards people like me who are a little bit further along in the game or tapping in to distributions right now and are looking for some of that current yield. Market capitalization is $34.74 billion. Earmark that number. That number is going to be important to all of us in a minute because I want to go through their balance sheet. I want to share the shareholders' equity because it's really cool right now and it has a lot of meaning, and it's one of the main reasons I actually added in a big way to my position. So as you can see on the screen though, below market capitalization, I want to also talk about AFFO. Diluted per share, because this company issues more shares. They actually raise capital two different ways. They raise capital to invest in real estate by going to the debt markets, and debt markets right now are really expensive, as we all know. We just looked at the long-term interest rate, which is huge. Short-term rates are high too, but they also can just issue new shares. And one of the things that investors worry about is when new shares are issued, is that a productive way to raise capital? And yes, it is in the case of Realty Income. They are being productive with the new shares issued. They're diluting all the shares, but the adjusted AFFO per share is actually still increasing. So as you can see on the screen, throughout the last 5 operating years, from 2019 through 2023, you can see that AFFO per diluted share goes up steadily each and every year. This is a quarterly number. This was from their recent quarterly earnings report. So that's not annualized, but it shows for this particular quarter, throughout all the years, AFFO diluted per diluted share is going up. I love to see that. It's actually going up by 5.1% per year on average, which is higher than the rate at which they've been increasing the distributions, which implies that in future years, they may be able to increase distributions even quicker, but probably won't because we're hitting some rocky economic times. So they're being a little conservative with their distribution increases. But this is such a key metric. Now, I also want to go into the balance sheet a bit, and I'm going to show this on a separate slide as well so you can actually see the balance sheet. But check it out. Assets are 53 billion and change, almost 54 billion. Liabilities are 22.7, say it, billion. Shareholders' equity, which is defined as assets minus liabilities, is 31 billion. Remember, I told you to remember the market cap. The market cap is 34.74 billion. Right now, if I take the 34.74 billion, I divide by shareholders' equity, I get a price to book on this stock of a 1.11. So one of the key reasons that I am buying Realty Income right now is it's essentially trading at book value, and this is a premium dividend aristocrat. This is a very solid company, in my humble opinion, as long as interest rates don't go up significantly from here. I think if interest rates go way up, especially because they're locked into long-term leases, it could affect the value of their assets, and then the assets devalue, and it could affect a lot of things at the company, including the share price, the price of the units. And so, of course, I have an overarching philosophy here and a hypothesis that rates are starting to plateau and that they'll probably at least plateau, if not go down over time. Now, if I'm wrong, if I'm incorrect and rates go way up from here, obviously my thesis would be inaccurate and I would have been better served to wait on my investment and not to invest in this company right now. Time will only tell. But what I want to do next is I want to share some of the items from their earnings report. So check it out on the screen right here. This is the balance sheet. I want to share this with you so that you can see the numbers not only through the lens of the Excel spreadsheet, but also through how I look at it when I'm doing my research. And so you can just see there on the balance sheet from their most recent quarterly earnings, it shows total assets, almost 54 billion, total liabilities, $22.669 billion. That's where I'm arriving at shareholders' equity. And you can see at the bottom of the screen, they actually calculate the total equity, which should equal the number that I just shared with all of you on the prior screen. And so what I also want to do, what's really helpful, is Realty Income shares the AFFO trajectory in their report. And this is what inspired a lot of confidence in myself, because even throughout the pandemic, they were growing the AFFO per share. So check it out on the screen in front of you right now. You can see there on the historical FFO and AFFO, the line item that was really important to me was the AFFO per diluted share, which shows it going from 82 cents in 2019 up to $1 in 2023. And this is a quarterly number. This is not the annualized number. And so now the fun stuff. I want to get into some of the pros and cons, some of the summary items, some of the really big philosophical items as it pertains to this particular company. And so I got my notes here. I got to look at them while I'm doing my presentation. And so, of course, one of the first pros is the starting yield at 6.16% paid monthly. That is meaningful to me as a dividend investor. So huge pro. Another pro is, I already discussed this, but it's a bond-like proxy, but it doesn't have an expiration date. And also it has built-in increases in yield on cost over time as long as the business model continues to work as it has been for so long. Now, of course, high interest rates and possibly higher rates ahead could challenge that model, so time will tell. Also, the next one I want to share is I love that the AFFO per share, when I look at the 4-year compound annual growth rate, it's been going up at about 5.1% per year. Of course, I love the current valuation at a PE equivalent in the 12s right now. I love that. I would say the 1.11 price per book is huge. And one of the things I didn't discuss so far is right now, as of now, occupancy at Realty Income at their vast portfolio of properties is up around 98%. That's where they expect it to be, upwards of 98% for this year. And so far, despite a rocky economy, their occupancy is really stellar. Now, what are the cons? What don't I like about this particular investment? I would say the first one is just these notes payable. And it's not only the 16.5 billion notes payable, but it's also just interest rates, cost of capital, the need to refinance, the need to really manage their leases. As I started in this video, this company will be made or broken based on the quality of the leases. It's not even the quality of the real estate, it's the quality of the leases, and it's their ability also to manage the debt and the capital against these leases. And so, as I said, they negotiate really long-term contracts. Those are great because they de-risk some of these real estate investments, because the investor like me knows, hey, rent's going to be coming in for the next 20 years. And at that time, hopefully they can either renew or get a new tenant in there. That's great. But when they're pegging these long-term investments in a time where interest rates are volatile, where they may have to even refinance debt higher than it was. I bet you most of this 16 billion debt that they have was financed at much lower interest rates than we're seeing right now. I hope that the debt maturity terms are similar lengths that match up with the actual leases, because if the debt maturity terms are shorter than the duration of the leases, they could run into trouble. And that's why I flagged those notes payable, because if those notes payable are payable soon and they have to refinance where they're still locked into long-term leases that are kind of at low interest rates or low cap rates as compared to current interest rates, that poses a real issue, because all of a sudden they're refinancing debt and their cost of capital is higher than the amount of lease payments that are coming in. And so the ability, I cannot underscore this enough, for Realty Income to manage their cost of capital, manage the capital structure against these long-term leases in an environment where the value of this entire company is determined on the quality of that particular scenario, how they're writing their leases, how they're matching capital against those leases. That is really huge. And that's a potential con, because that's a hard job to do. And we're in unprecedented times right now where we haven't seen this kind of interest rate volatility in quite a few years. Thankfully, Realty Income's been in business long enough where they have seen this kind of interest rate volatility before. And hopefully they built that into their operating structure. If you know more about that than I do, put in the comments below. I'd love to know anyone here in the community has done some extensive research on Realty Income and how they're matching assets and liabilities, leases and capital structure. I would love to know. By the way, if you enjoyed the video so far, please don't forget to click that like button. It means the world. I know it's been a while since my last video. I thank you for your patience. It means the world. I've been so busy at work. been on my hustle. And so thank you for your patience. I am excited to be back here on YouTube. I missed you all, and I can't wait to see you in the comments. All right, and so in terms of more cons, honestly, I don't have that many. I didn't write it here on the whiteboard, but perhaps I should have said taxes. Taxes with real estate investment trusts are different than qualified dividends. Qualified dividends are typically treated here in the United States as long-term capital gains, but with companies like REITs, like Realty Income, oftentimes there's an ordinary income component, there's a return of capital component. It gets a little more tricky in terms of the taxes and a little more expensive in terms of the taxes. So this 6+% yield isn't comparable to a 6+% yield in a qualified dividend. Just something worth noting. But one of the things I love about real estate investment trusts and Realty Income in particular is they don't pay a ton of taxes at the corporate level, so they're able to save on the taxes at that particular level. And so that's it. That was my big move in the stock market. I actually have another big move I'm going to make this week. I can't wait to share that. I've already foreshadowed what I'm going to be doing to my patrons. I'll link to that in the pinned comment below. But it's one of my core 4 stocks. I couldn't pass it up. It's on sale right now. It's an exciting time to be a dividend stock investor because the portfolio value is kind of tapering off a little bit. It's kind of holding its own as I add more money, I guess. But the income stream is growing. And it's kind of like that spring analogy. The spring's getting compressed, but it'll catapult open at some point, but it could be a while. It could be a while, especially if we see a major recession around the corner. And that's another risk, by the way, with Realty Income. If that vacancy rate goes up, of course, that's a business risk as well. But historically, they have not had issues with that in a major way. They've managed that risk really well. All right, everyone, before I go today, I want to give a full disclosure. In terms of full disclosure, I am long Realty Income ticker O. Also, I'm long Treasury bonds, including the 20-year Treasury bond. In terms of a friendly disclaimer, today's video, it's not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult your licensed investment advisor first. I'm just sharing my journey here on YouTube for fun and entertainment. It's possible to lose money in the stock market. So please do go out and consult your licensed investment advisor. I'm just sharing my journey for fun and entertainment. I love you all. I'll see you in the comments below, and I'll see you in the next dividend stock investing video.